Hi guys, this is Abhishek Sharman. I'm the founder and managing director of a private equity firm called Carpediem Capital Partners. We are a consumer and services oriented fund, invest in sustainable businesses, which are either trying to create a consumer brand or trying to create an organized service. I started in 2005 in a fund called Sun Capital Partners. Then I went to a fund called India Equity Partners, and then finally at the end of 2013 I quit, and along with two other partners, I set up Carpedium. We've been operational since 2015, and that's what I continue to do currently.
Okay. So tell me about the kind of skill sets which you need to develop in private equity. Like, you spent your whole career there. When you joined, you obviously uh, must have been as clueless as any fresher would be. So what were the kind of skill sets that you developed, which you feel people should develop to build a career in this space?
I think private equity requires a certain amount of maturity. So I think while some maturity happens with evolution, as we all evolve, but even within the peer set, I think some people are more mature than others. I think private equity is certainly something that requires that because it's a business. It's in some ways a strange kind of business because you are dealing with a lot of other people. You're managing other people's money, which you're betting on certain other people. So your karma is not really in your hands. It's in the hands of many other people who decide to do what they want to do. And at the best of times, things are not in your control. You know. So you have to build businesses vicariously. You have to have a strong sense of fiduciary responsibility towards other people's money because that's what they are looking at. Uh, so it is a balancing act between uh, uh, a very sophisticated set of individuals or institutions who are large enough to be able to write big checks and betting in other people who you think have the future potential of becoming big. Uh, and therefore, you have to be able to manage the two, which in terms of skills uh, requires a lot of patience because you're dealing with others. It requires you to be able to look beyond what is obvious and see the potential of what things can be, which may not be uh, very very easy to see now, but some of it is objective, some of it is subjective, and you put that into a decision making framework and then realize that whatever decision you have made, there's only a probability of success, um, and you will go wrong, and that's part of the business. But the only way to live life is passionately, so you keep on doing it, and if you're right more and more times than you're wrong, then you've done your job well. So I think, yeah. So, so I think it's the ability to do all your work and yet realize that there is only a certain chance that while you may have done everything that you could have, there's only a probability attached to the fact that it will work out in the way that you want it to work out.
So, in a way, you're saying that you need to be passionate and yet detached because you can't get attached to every investment because you know that, let's say, only 2 out of 10 investments will give you like 3x, 4x, 10x kind of returns, and two of them you might have to write off and so on. So, like being detached is important to be an investor.
I think being objective is very important to being an investor. Uh, you're right. In a sense of detachment. I think somebody told me, uh, which is quite parochial, but I think, I mean, you'll get the gist. Somebody told me that, your investments is like your daughter. So you have to, while she's with you, uh, she means the world to you, but you know that one day you have to let her go. And I think, you know, it's probably not the best statement as far as gender equality is concerned, but I think it conveys the emotion very well of the way you have to look at your investments.
What about having a big picture perspective? I think the main difference between founders, especially first time founders who seek funding, is that they are very attached to their idea, whereas the investor looks at the big picture and says, okay, it's an interesting, innovative idea, whatever, but will it really scale up? For that, an investor needs to look at the bigger picture, the total addressable market and the trends and so on.
So, I think my perspective is slightly different. I think it's all about execution. I think the idea, the TAM, uh, to a certain extent, is less pertinent because in India there are many interesting forests. Uh, it also depends on the kind of things that we invest in. So we are what you call an early stage private equity fund. So we look at which are between 30 and 200 crores in revenues. So by the time you are no longer backing just an idea, you're backing an idea, but there's also a certain amount of product market fitment and you have a certain amount of execution. I think to me, you know, in order to make money, in order to get to a certain scale, because our success is not dependent upon the fact that every company has to become a unicorn or has to become an Apple or Google or so on and so forth. If you're looking for a 4x, 5x, you just need to have a 10x potential, which is that you need to capture the 3, 4x, and the other guy is coming after you. He should be able to see a 3, 4x. And that, at the scale at which we enter into companies, is possible in a large number of sectors with a large number of companies and a lot of founders. But I think what people don't realize and what the founder community probably doesn't realize is that in order to visualize something where nothing else exists, you need a founder because you need an unreasonable man who needs to be attached to an idea, who needs to make it work despite, all the naysayers and everything going wrong. But to take something from 0 to 100 is very different from taking something from 100 to 1,000. And that requires the whole process of institution building to kick in. Uh, Team, processes, the ability to let go, the ability to say that, I would intervene only in certain ways, through certain people, at certain points. And I would not like to be at the forefront of each and everything, so to say. So that realization is very important. That commitment to institution building is very important, and that focus on execution is very important.
So there are some funds which have this philosophy of go big or go home. So you are saying that that is not your philosophy. You're not looking at one or two of every 10 to be outsized returns and the others then you don't care much about. That's not really how you operate.
Yeah, we are looking for Michael Bevins. We are not looking for Virendra Sehwag.
I'm not much of a cricket follower. I know Sehwag, of course, but I don't know the other name that you mentioned. But I'm assuming that's someone who's a consistent player.
Exactly. So we are looking for people who, uh, you know, we don't like losing money. Uh, that doesn't mean that we won't lose money, but we don't like losing money. So you're right. Out of 10, maybe one or two don't work out. But to us, at least making it 2x, 3x in every investment is important because we are not coming at that stage where we are not a classical angel or a VC fund in the sense where we are coming in at a very inception. And we are also not seeking 20% month-on-month growth. We are seeking 25, 30% year-on-year growth, because our view is that there are very few businesses which can grow at that rate without the wheels coming off. And, that kind of disproportionate growth is only possible in certain situations. Let's say a tech platform is and takes off and so on and so forth, etc. But most businesses, in order to do well, in order to thrive, don't have that very high benchmark. Right? And if you look at a country like India, and if you came to India in 2010 and you saw a company called Julian Foodworks, it could be a $125 million company. At the end of the decade, by 2020, it was a $7 million company. Mm, If if you came to India in 2010, you may not have heard of a company called Page Industries, which sells jockey innerwear. By 2020, it was a $5-6 billion company. uh, a Dabur or a Pidilite trades almost at SaaS company kind of valuations. And these are companies which don't do something which is very disruptive. So the great Indian opportunity, because we are largely India focused fund, the great opportunity in India is that we are looking at probably the biggest accretion to the working population of the country that any country has seen across the across the earth at any point of time. this demographic is what we are playing most of the time. We are not playing necessarily a tech disruption, and therefore the vantage point at which we look at businesses is that if you can build a consumer brand that appeals to people, or if you can build an organized service that appeals to people, which can target the large middle class, apart from the bottom of the pyramid, because at the very bottom of the pyramid you don't have purchasing power, but if you go a little bit above, I would say the bottom center of the pyramid, if there's a product or service which is relevant for that segment, you can really build very scaled up businesses. And these are businesses which can grow for the next 20, 30, 40 years. And at that point, in that category, you can play, I would say, a little safe. You don't have to play everything like 80-20 over. I mean, you 50 over view. I mean, you don't test match cricket, but you play I would say 50 over one day cricket.
Interesting. So essentially, you're placing a bet on the per capita income rising, more people coming out of poverty to middle income, middle class, and that middle class driving more consumption of services and products. And so that is what you're placing your bet on.
So we are at the confluence of two data points.
Hmm.
One is what you said, which is greater consumption. We keep talking about India moving from $2,000 per capita GDP to $5,000 per capita GDP. Now, whether it happens in 5 years or 8 or 9, that's less right on my view. But directionally, that's where we are going. Important part is a lot of this incremental purchasing power, and therefore a lot of these incremental spends are going to come into consumer discretionary segments. So the ramen ration has been taken care of. This is not going to go into dal chawal and roti for brahmagarnis. But it is going to go into categories which have so far not been focused on necessarily, because your core spends were always for core things, and the incremental spend now therefore has a huge hockey stick curve. I mean, I talked about pizza as a category, and who would have thought that in India you would have such a large pizza company? Then we talked about jockey innerwear. I mean, if you look at Maruti cars, I mean, Maruti Suzuki is more valuable than Suzuki. And similarly, we think there are many categories. For example, we think women's shoes as a category. We think pet services as a category. We think funeral services as a category. These are all categories which we think are going to explode. The other data point which is important is that one is the per capita element of it. The other is uh, the number of households of a country is actually a greater barometer of consumption rather than the population. So, uh, what's happening in India is what I call a nuclear family revolution. So India is moving from a joint family ecosystem to a nuclear family ecosystem. And when one households become two households, if you're two brothers living under the same roof, is two brothers who are living separately, spending goes up by a factor 1.6 to 1.8x, because you need two of everything. And that is a greater barometer of how consumption is going to move, rather than the fact that we have population of 1.4 billion, it is going up 1.8% per annum. And that is what people miss out on. So because we are going to see more number of households, and because we are going to see more per capita um, income, I think we're going to see both volume as well as propensity to spend increase. So we are the confluence of those 2 points, and therefore there's certain sectors which will grow much more than other. So maybe a guy who's making rice will make more rice, but his growth from a base level is going to be lesser than somebody who is a pet services player, and the base effect that he's going to see and the accretion that he's going to see.
Got it. Interesting. So, it, it, tell me about the journey of starting up on your own. What made you want to leave India Equity Partners and start on your own?
So I think, I mean, that's the natural evolution that everybody seeks. I think the more interesting part is how did I think about private equity, and but that story a little bit. And what happened was that I was a student night in Delhi, and I had gone to IIT, um, and actually I had gone to Delhi after being in smallish towns like Raukela and so on and so forth. And we were not initiated too many English movies. And when I went to IIT, computers happened. And so in my first year, I went to Nehru Place in Delhi and got assembled a computer PC for myself. And we used to get all kinds of movies in all kinds of ways. But we watched a huge number of movies. And all the movies I watched was a movie called Pretty Woman. And Richard Gere used to play a role there. And, I mean, obviously, you liked what Richard Gere did for many reasons, in Julia Roberts. But what caught my attention was that what does this guy really do? And I was in the first year in college. And in IT, you live in a hostel, you go to your seniors, because they didn't know all, and you look up to them. And I went to many seniors, and most of them were not able to articulate till I bumped into somebody who could, and he said there's something called private equity, and that resonated, right? That resonated that here's a guy comes, he you know takes companies, buys them, takes them apart, does various kinds of things. In the process, also does other stuff. And so therefore, I am probably one of those people who have done nothing else in their lives, uh, but private equity. In that sense, I'm quite unique. I haven't come across many other people who have done that, which could also be a weakness, but that nothing better. So that attracted me to private equity. And there was always a desire that I had not to join large platforms, but be part of platforms where you could join at the very inception, very beginning, and make it your own, or go to the absolute top, rather than looking at a US based private equity fund where the bosses sit in Boston or New York and you're in India, and you're spending a lot of time telling about the India story and why India makes sense. So I feel that you spend a lot of time doing stuff that uh, you know is just understood and should not be core of any investment thesis. uh, and that is why I chose the kind of private equity funds that I chose to be part of.
Hmm.
And at a certain point of time,
That's probably why after IIT you went straight to an IIM, like because you had no intention to really take up an engineering job.
I was not good at it. I mean, I would have been very lousy at the engineering job. I went to IIT. I didn't go to engineering. Engineering never fascinated. That was the reality. And the good part about IIT is that more than what they teach you at IIT, I think you get to test your metal against some very, very smart people. And that holds you steady, whatever you do in life, you're always very confident. And that is what I took out of IIT. And it was very clear to me. Even in IIT, I went to Procter& and Gamble for internship, which was a great, great institute. It taught me a lot. I put 64 days in a plant which made Ariel and Tide. And I tried to make the making machine and the packing machine talk to each other. And while it was an engineering problem, the solution for it was basically, you know, take a bunch of people along, somebody who comes with technical experience, somebody who can do the problem definition well. So it was ultimately a managerial solution. And I felt that I had a lot of logical sense. And that itself is a rare commodity in life as we all you figure out. And therefore, to me, going to a management going to a B school was a very natural process evolution. I could either have gone to a consulting firm like a McKinsey BCG, or I could have gone to a B school. Uh, I couldn't do the first, but I could do the second. I went there. And then, as you rightly said, so that transition was natural for me. And then because I wanted to do private equity, that the first chance I could get, I decided to go there. Chose firms which were not necessarily the biggest brands, but where I could be, more relevant, and always got a disproportionate amount of responsibility and experience. That is why, at the age of 33, then I decided that I could try and do something which was my own, because the bigger issue was raising capital, and it was clear that if I could raise capital, I could do the rest.
Did the India Equity Partners experience shape your investment thesis? Like what was the investment thesis there? What kind of companies were they investing in there?
So Indian equity partners was fairly diverse. They did investments which ranged from $10 million to let's say 35, $40 million. Um, I always focused on, so because I wanted to be independent, I wanted some responsibility. I wasn't very senior, so nobody wanted to give me a lot of responsibility. So I ended up focusing on doing sub $10 million deals in the consumer and services segment. And some of my investments where I was part of the team and it turned out very well. One of the investments I made was in a company called Manappuram Finance. And we wrote Manappuram Finance from a company that was 400 crores in your loan book to about 10,000 crores in loan book. So the company going public, created, great value, almost a 7x in constant currency terms over a 5.5 year period. So that was a great experience. Then I was on the board of this company called Quest Corp, which is now a listed company. It is India's second largest private sector employer, employs close to 150,000 people. Uh, and from its very infancy, we went through some very tough times because we invested, and then Lehman went down. Nothing we did that, but we got impacted. We kept our faith. We kept supporting the company. The company turned around quite well. In 2013, we sold the company to Fairfax. Uh, made a, we made it 40%, close to 40% IRR. We thought we had done a good job. Till we saw Fairfax making a 16x, taking public 3 years later. And then and all those things were great learning. So I was associated with a few companies that did quite well. Uh, India Equity Partners obviously, made 16 investments across the board, very diverse. But what it did is it gave me a very good vantage point in being able to see what works, what doesn't work. Uh, what are the elements that I really want to follow. And what we did is that we borrowed what we ought to have kept. Obviously, uh, it is also constrained by the amount of capital you could raise and what you can follow and so on and so forth. But uh, it very much was the edifice of the good elements of India Equity Partners was very much the edifice of what we created in Carpediem.
Hmm. Okay. So, what did you learn about what doesn't work?
So I think what doesn't work is cyclicals from a sector perspective.
What does that mean? Like,
During the cyclical industry, like you invest in auto component companies, you invest in infrastructure companies, you invest in cement companies. It's very difficult for from private equity point of view to be able to time cycles. You know,
why are these businesses cyclical?
because their output prices are linked to commodity prices. The output or input price are linked to commodity cycles. If steel goes up, it goes up, and if steel goes down, it goes down. And there's nothing that you can do about it. Uh, the whole element of, if you go back to the resiliency of private equity is supposed to be able to generate alpha for you, which is an element of return which is non-linked to the market. And the core of it is access to operations of the business. So if you look at the classical private equity funds, which have become large, they have now become more asset gatherers rather than private equity funds. Uh, you know, they started by buying out companies, right? So when a Blackstone buys a Hilton Hotels or somebody buys a One Elevator, they take these companies, they install management. They're able to fundamentally make changes that is supposed to increase the operational efficiency of the business. Um, so in private equity, when you're with that mindset, you don't want to buy a 6% ownership and hold a Series B preferred stock in a company. You want to own businesses, right? And therefore, we said the cyclicals don't work. Small minority stakes don't work. Blind reliance on entrepreneurs or promoters, as we call them in India, doesn't work because in India you don't have a board-run mechanism most of the time. You're backing these unique individuals called promoters, which are a combination of founders, shareholder, management rolled into one. You know, so the challenge in India is to manage the promoters. The opportunity in India is to partner with these superhuman individuals who are called promoters, and therefore, you want to be very careful about the kind of people you back. So, so to me, it was important that in India you can't be passive. You can't say that, oh, there's a great guy, his name is Steve Jobs, and I'll give him some money and he'll make me $1 billion. It doesn't work. You know, India is also a tough country to do business. There's the environment which is tough. Making profits in companies is very tough. There's so much taxation, direct and indirect, that you have to deal with. You're dealing with so many regulatory and compliance hurdles. So we said there are some elements that we want to take here. We want to back first generation entrepreneurs. We don't want to back partner families. We want to take
Why not? Why not partner with families?
because what's happened is that if you look at wealth creation, it is moved from being generational to a single decade. Uh, the logic of partnering with families was that there are certain business families who know how to build businesses. So Dhirubhai Ambani starts a business, Mukesh Ambani takes it to a certain level, and maybe the next generation takes to, let's say, XYZ level. And that's no longer true. Elon Musk is the richest guy in the world, and he's not a family-run business. Neither is Jeff Bezos. In India, I went to IIT. If you look at a lot of people, my time, my juniors, my seniors, people who have done well. Sachin and Dilip doing Flipkart, Deepinder at Zomato, Albinder at Grofers, Sujit Kumar at Flipkart, Ola. All in one generation, a lot of wealth has been created. You don't. So the whole idea about partnering with families was that they know how to build businesses, and businesses get created over generations. That is no longer true. One good entrepreneur in a period of as small as 5-6 years can create a huge amount of wealth. So you want to back individuals, uh, and they could be professional entrepreneurs. So we love professional entrepreneurs, people who know the business. They may not have the capital, but they understand governance. They understand the fact that how to treat fiduciary capital, and you back them and you work with them in the make or break innings. When 97-98% of the net worth is inside the company. And what we do is we take meaningful stakes, 26% plus stakes in these companies. Spend a lot of time in these companies. We like to spend about 3-4 days a month with these companies. You know, so if somebody feels that we're interfering or whatever, then we are not for them. With the whole idea being that while we back these guys, we are co-building businesses. We are not passive. Uh, we are business partners. In three out of our 8 portfolio companies, fund one, we are the single largest shareholders ahead of the promoter. But yeah, we are always the second voice in the company. The most dominant voice in the company is always the entrepreneur, right? And then we say that we want to not only get investor money, but we also want to get customer money. We like to say that 20% of the sales of the companies come because of us. Uh, we appoint the financial controller, we appoint the employee auditor, we appoint the statutory auditor. So ours is a very hands-on, let's build businesses together kind of style. People appreciate it, will like us. And therefore, we choose very carefully. And that also happens because we don't have to do a lot of investments. We do like 2 investments a year. We do about 7-8 investments from a fund. None of our companies have a single rupee of government revenues. And again, if you look at how many businesses have been built by providing services to the government, it may be a very small number which are successful business, right? So, so we therefore have learned our lessons. We think that from our past life. Uh, my partners, one was the founder of Quest, the other was CEO of Domino's, and bunch of the companies. So because of that, I think we have a sense of how consumer service business can scale up. That's the peak that we understand. We have a style that works for India, and therefore that is what we are focused on.
Okay, got it. So, some of these things which you're talking about are not considered very fashionable today. Like I think what's more in fashion in the last 2 years is like hands off, writing checks quickly, uh, kind of approach. Does this hamper your ability to find the best investment opportunities?
The periods of time it does, right?
Mm.
And, because ultimately, if you look at the pool of entrepreneurs, some of them do gravitate to ideas where you can get high velocity, high valuation capital, right? So if there is a guy who is deciding to do entrepreneurship, and he has a choice between building a sustainable business versus a choice of building a business where you can talk about multiple rounds of capital and each round valuing him higher. He may choose the other path, and, and that can happen. But that's why I think it's important to have a value and belief system that is very core to you, because it is very difficult to hold on to it, particularly when you get tested. So if it is not very deep and not very intertwined with the core of who you are as an investor and what you embrace as a philosophy, it is going to get tested. There's absolutely no doubt on that. But my point is that you can make money by doing whatever you do. Profitability as the new mantra. But these are not blinding insights. You know that at some point of time, sooner rather than later, business has to generate cash. One can have a view on what that leeway is, and I can understand that in a world, let's say if you're paying interest rates, and you say that there was a world where we were looking at a zero interest rate environment, where capital today versus capital 10 years down the line had no difference because the discounting rate was zero. You could have taken a much stronger view. And today, when the discounting rates are going up because inflation is going up and interest rates are going up, you suddenly feel that cash today is more important than cash tomorrow. But the fact that cash is king, the fact that profitability is good, is not is not new. It's just that suddenly people believe at some point of time that this time it's different, and this time it's a new world. And to me, is the pendulum effect. You can deviate from the mean, but the mean remains the mean. So there's a period of time for which you can focus on certain other things because the world is going through a phase, COVID happening, philosophy's changed. But in the long run, when you even out all those things, there are certain truisms, I think, which hold. And therefore, what we practice is nothing which is blinding insight. To be honest, this is what has been by many people at various points in time. It's just about being able to execute on it.
So you said last year companies were overvalued. What is, uh, I mean, what is the way in which you value a company? I mean, because you are in a way taking a bet here. So how do you really value a company? How do you decide this is the fair value for a company? Are there some rule of thumbs, like say 3x of revenue is a fair value for this kind of business, or stuff like that? Like,
So what we do is we look at imputed EBITDA multiples. So EBITDA is earnings before interest, tax, depreciation, amortization. It is a I would say proxy for operating income for business. Ideally, it should be EBIT, but leaving those technicalities aside. So business operationally, what is the kind of money the business can make? Now, the stage at which we come in is when a business is sustainable. So we like to come into EBITDA break-even on positive business. However, we understand that it's not a level at which they are showcasing their end state EBITDA, right? So let me give you an example. Let's say when I invest in a FMCG kind of company, let's say the company is making ketchups and sauces. Now, there's no point me looking at a Heinz kind of multiple because the Heinz is a very mature company and it makes, let's say, lots of EBITDA. And it gets valued on price to earnings ratio or EBITDA. But I also don't want to look at a situation where I go and say, oh, it should be 3 times sales or 4 times sales or 5 times sales. So what I will do is I'll say that, let's say here is a company. It has got 50 crores of revenues. Uh, it is profitable. It is making, let's say, 2, 3 crores of EBITDA. Obviously, it's not making a steady state EBITDA. Now, I would say that, let's say, this company, when it gets scaled up, will make a 15% EBITDA margin. Let me give the full benefit of that at the scale at which it is. So I'll say let's assume that at 50 crores it makes 15% EBITDA margins. And what multiple would that get me? And let's say this company goes at 15 times EBITDA. So it will mean that I should give the company a 2.25 times enterprise value to sales multiple. Now the company is not making 50% EBITDA margins. And then I would say that that's what I will give it on a full basis. And I would ideally want a little bit of discount, and that's a subject matter of negotiation. But while I effectively give it a sales multiple, which is let's say 2.25 times sales, the question is why am I not giving it a 4 times sales multiple? Right? To me, uh, because we all have to look at valuation methodologies that work for us. I mean, For a VC who is bringing a company with is no EBITDA, doesn't mean the value is zero. So they come with, let's say, sales multiples and fraction multiples and so on and so forth. I look at imputed EBITDA multiples, and I would like to give the other people the benefit of that. But at the same time, that to me is the absolute maximum at which I would be willing to price. Now, if a company, for example, is a personal care company, which is a 70% gross margin business and can deliver a 30% EBITDA margins at steady state, I would deal with it very differently, in terms of the EV to sales multiple. But that EV to sales multiple has been arrived at by giving an imputed EV EBITDA multiple. Because to me, ultimately, this company has to be profitable.
Hmm. Hmm. Okay. This 15 times EBITDA multiple that you shared as an example, it varies from sector to sector, or what is the range, like the multiple on EBITDA for which, like the kind of valuations that companies get?
It varies. So, for example, if you're looking at restaurant sector, you look at what are the restaurant comps, right? I mean, when we did, let's say, a company like Biryani Blues, we looked at the comp set that was there for listed companies in the food and services space, you know, uh, and and then if you're doing a ketchup company like Adna, then you look at what would be the multiples for that. And when you looked at a mobile repair refurbishment company like Yaantra, which is a business that we sold to Walmart, we looked at what kind of multiples services of that nature get. So obviously the comp set for different businesses is different. And that becomes the most pertinent way of valuing, because while theoretically, the value that the company has is a discounted value for the cash flow it will generate, but it's very difficult to project future cash values. It's very difficult to sort of, it's very sensitive to the assumptions that you take. So often CF, etc., is a work of art. Comp set and the comp set done across cycles, not only at this point in time, but a comp set done across cycles, which gives you ranges that this particular industry is pretty right. Then sort of adjusting it for your company, the kind of margins that it is likely to be able to execute, and then providing a multiple on that, and that is what has worked best for us.
Yeah, by comp set you mean comparable companies set, like
That's
set of compare. Okay, got it. Okay, okay. So coming back to your own entrepreneurial journey, like in a way, starting a fund is also like starting up as a founder yourself. So you told me that you felt that the big challenge for you at that time was raising capital. How did you solve that?
No, it's something which is tough at the best of times. Raising capital, because India is a starved capital market. Uh, in the US, 90% of the private capital comes from US. In China, till some time back, I don't know the situation now, but 50% of capital was renminbi capital. So because your access to domestic capital is less, you have to go out and raise capital. And therefore, large scale pool of pools of capital uh, can only be raised if you're able to access global markets, and that requires a certain set of things. For example, the global markets love people coming out of a brand. I mean, if you worked at Sequoia and suddenly you decide to, chances of you having being able to raise institutional capital is higher. We also saw a speed of managers who were actually based abroad, but running India funds, you know, and they were able to raise large capital because they were closer to the investor, and therefore the investor felt more comfortable in giving them the capital uh, you know, rather than giving to people who are in India and who might know India better and who might be spending more time in India, but at the same time because they don't know them. So capital raising, I think, is a work of art. It was very different from. I mean, obviously, when I went to IIT, I wrote an exam called JEE. I went to IIT. When I went to IIM, I wrote an exam called CAT. Here, there is no exam. It's a lot of intangibles. You think that you're surprised at the amount of capital some people are able to raise. You're surprised at how little capital some others are able to raise. So it's difficult. But what happens is over a period of time, it was a challenge. It was exciting, but this was one thing that I needed to learn. I mean, everybody wants to learn new things. So while I thought I knew investing, I mean, you never know investing, but you have a paradigm for investing. You had a paradigm for dealing with entrepreneurs, with portfolio management, but this was completely new to me. So it was very exciting at some level. It was very challenging, and I think what really helped is that we took the approach that any startup will take. Right, I mean, a startup will first put to friends and family around. I mean, there are some startups who start with seed capital from home. Yeah, you're not one of them. So we went to friends and family, when people close to us, raised the first fund, which was about 204 crores from India largely. I think, thankfully, what happened is that there was an ecosystem of institutions in India, and there were certain people in India who were willing to look at the asset class. Obviously, the money was really small, so you had to go to many different people like small share. But I think the AIF regulations came in 2012. Uh, I think some companies, some institutions like SEDB, for example, in India, played a phenomenal role in sort of backing managers and creating that ecosystem, almost like a Y Combinator accelerator or something, for Indian funds. So that ecosystem also came along. I think India started doing a little bit more allocation, and then we also got better at it. Today we have investors from various different parts of the world. Obviously, the mainstay of capital is still India. Uh, you know, and it's been an evolution. I would not say that we still haven't been able to raise very large amount of capital, but that's a journey that we understand now. We are getting better at it. And today, if you ask me, is not necessarily the biggest challenge. We view my view is that what happens is that over a period of time, what you think of as challenges, because you solve for them, actually become lesser of an issue than you thought they were when you started out. But the set of things you did not see as challenges or did not count for actually become more pertinent pain points for you as time passes by.
So, what are they now? These unaccounted for challenges.
I mean, when you start a private fund, you think your job is raising capital, finding great investments, and exiting and so on. So I think when you run a business, you realize that, for example, people has become a very big challenge now. There was a time when just because you're offering a private equity job, you could almost get anybody interested. Uh, no longer the case. Uh, People, I mean, today, youngsters today, those who are coming to the workforce have many more opportunities. Uh, Many of them think of the risk rewarded being an entrepreneur as being much better. Uh, you know, and so entrepreneurship is today probably the most attractive segment for people who are looking at a career. Even in private equity, what has happened is that the big have become bigger. The scale at which they operate, what they're able to provide, is very different for what an entrepreneurial private equity fund can sort of do. Therefore, uh, while you can give them equity, you can give them long term rewards. There is a huge challenge in terms of being able to match what other people are able to provide. So I think all people are becoming a huge challenge. The amount of time you end up doing stuff which is regulatory in nature, the amount of time you in stuff which is admin in nature is actually a very large proportion of your time. Particularly when you're also running a business. I mean, you're not doing this. So the whole act of running a business takes a disproportionate amount of your time, and you end up spending far lesser uh, than what you'd like on doing stuff that you really like. Sit with the entrepreneur, discuss strategy. Uh, sit uh, with a counterparty and discuss and then negotiate a deal. There's a lot of other stuff which you think existed, which actually takes a huge amount of time. So I think those uh, your ability to not get tired by all that, anyways, defines your ability to be successful. And not so much, some of the core things that you thought would be challenges. At least you realize as you go along, you know, and it's very different. When you're an employee, you have a task. Like you have to do 2 deals a year. You have to manage 2 3 portfolio companies. And you do a good job of it. But to get to that stage where you have an organization where each of them, each of us can do things that we really like to do, and the aggregate of that is enough for for an organization to be able to fulfill all its objectives. I think that really, to my mind, is the holy grail of being able to build a successful institution in business.
Okay. Okay. You said only 10% of money raised by private equity in India is from domestic sources. Why is that?
Because India, everybody sees so much opportunity. The largest families in India, India,
Hmm.
if you go to uh, Gautam Adani or if you go to Mukesh Ambani, they will
Hmm.
say, "Be the capital." And I will generate the return.
Right.
The Rockefeller families and the Chanel families and the Bloomingdale families and the Gates families, they and the Wharton family, they all created businesses and now they're dynasties. So now the generations, the gen after that, they're capital allocators. Right? They're not so much in terms of building; they're more in terms of managing. Uh, so they've gone to that phase. In India, we're still at that point of time that people are seeing huge ability to create disproportionate amounts of capital. Generational businesses, are seeing this as a point of time where you can create disproportionate amount of size in those companies. The Tatas are seekers of capital. You know, uh, builders are seekers of capital. The monies are seekers of capital. The Adanis are seekers of capital. Everybody is seeker of capital. Who is the giver of capital?
Yeah. 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 Right.
IT services, let's say for the professional entrepreneurs who, Narayan Murthy, and then and Nandan Nilikanians, so those are the kind of people who today are, looking at managing capital. They're you know, looking at developing an ecosystem for fostering entrepreneurship and stuff. So Indians are very hands-on, and rightly so. They're seeing huge amount of opportunities. I mean, one is just around, I think, some $80 billion investment in hydrogen. So I don't think that they're going to have spare cash to give to people to quite some time. So that's a challenge, right? But I think it will be very different the next generation because that zeal is not a family zeal. That there's nothing but a generational zeal, right? It is with individuals, and then as generations change, some people decide that now I have a lot more to conserve than to build. I've built enough. And at that point of time, things will change. But at this juncture, because we are looking at a career, or we are looking at a period of time which is relevant, let's say, for the next decade or two. Right? If you look at that period of time, I don't think you can restrict yourself just to India. In terms of your aspirations in those capabilities.
Mhm. Okay, so take me through your like the resume of Carpediem. Let's say, like fund one was 200 crores. What kind of investments did you do, and did you get some credibility building with fund one that helped you to raise a bigger fund two? And what fund number are you at currently? Like,
So we are in the process of raising fund two currently. So we raised fund one. We did a final close in September 2016. Fund one does well. We are on a invested capital level tracking toward 29% IRR. Uh,
what does that what does that mean? Uh, because this valuation is like subjective, or is it like based on actual exits, or what? Like,
so so we invested across 8 companies. So we have time till let's say 2020 to deploy capital, which we did, and then we have time up to 2025 to exit our companies. So one out of the 8 we have exited. We have returned back 48% of the capital of the fund on that one exit. We invested about a little about 24.7 crores in Yaantra. We got back about 100, and that was enough for how the fund that happened at close to 34% IRR. Um, the rest of the portfolio, we went 5 out of our other 7 companies having markups. We invited Rebel Foods, which is a food unicorn in our food service company called Biryani Blues, which was at 4.6, 4.7x of where we came in at. Uh, we have seen similar uprounds in our other companies. We have a European company called One Indian Family Mart, where we Gulf Islamic Investments. We have design build services company called Flip Spaces that does very well, where we had an extra at about 3x. we have seen an up round in a microfinance business which is called Sindhuja Microfinance, where a sophisticated global microfinance investor called NMI came in after us, Waka. So we have a portfolio of 8 companies in Fund One. We have divested one. We have had up rounds in 5, and 2 of the other companies where we haven't raised further capital or profitable have grown 2.5 to 3x since we invested. So we think we have a portfolio where we may not see too many accidents, too many impairments, uh, and which was in a particular difficult vintage. We went through demonetization, we went through the implementation of the GST regime, uh, we went through several waves of COVID, and what we're investing is not strictly tech. So yeah, we faced a lot of challenges. But I think we selected companies well. I think we worked hard at them, and kudos to our entrepreneurs. The way they have kept the zeal and kept the mojo going in tough times. And that's why, as I said, the challenge and joy in India is to partner with these unique animal called promoters. Uh, so so that's been reasonable journey. I would say we are pretty satisfied with what we've managed to do. And we are building on that success. We are in the process of raising the 700 crore fund. We have 2 kids there. We have also invested in a couple of companies from fund. So capital deployment started. Our aim again to look at 7 to 8 investments, like Fund One, work very closely with these companies. So that in a nutshell is where we are.
Okay. Okay. Uh, so you said Fund One by 2025 you need to return the money. So does that mean you need to sell off your stakes in those companies by then, or like what does
Yeah.
that imply?
Yes.
Okay.
I mean, in a nutshell, yes. I mean, there are mechanisms. You can take extensions. You have to do that in conjunction with your investors, in conjunction with the regulator. There have been situations where people have gladly extended. I mean, I think it was Bain Private Equity which held on to Staples for a very long time. Staples in the chain of retail stores in the US. Because that company was doing very good and was doing some 15-20% yield and so on and so forth. They felt there's no compulsion to sell. Um, in India, because there's a regulatory involved also, so there is a finite life after which, even if investors want, the regulator may not oblige. So I think we have to find solutions for these companies. And there are a range of solutions which are available. There are secondary funds, there are continuation funds. So you move assets from one fund to another fund. You could raise funds where you say that, I'm going to buy assets which are left out. Because typically what will happen in a private equity style is that, and then we have less, and that the people who have got 100 investments in a portfolio. And to find solutions for one of them is not always possible. I mean, you can always write off investment, but that's not a great solution to find. So certain things need more time. And, the good part is that much like the primary market, the secondary market is also evolving.
So like your Fund Two could buy off Fund One companies and return the money to Fund One investors.
So that would typically not happen. If you have to do that, then you have to raise a fund specifically for that. So usually marking up your Fund One investments from Fund Two or giving exits to Fund One from Fund Two is bad practice. There are ways to do it. You have something called a LBAC, which is Limited Partners Advisory Council. And you have to take both the LPs into consideration, a fair market valuation done, and do something on that basis. But the usual solutions are that you either go to a secondaries fund, and which can buy entire portfolio, or you raise something called a continuation fund, where you say that I'm raising this fund, which is a continuation fund for Fund One. It is going to buy companies of Fund One. These are this is the methodology that we're going to follow while doing that trade, because it's an exercise which is laden with conflicts.
Hmm. Yeah.
In our business, you have to be pure as Caesar's wife, as they call it. Right? So because your money, you can do whatever you like, but giving other people's money, I mean, and it's about long-term reputation ultimately. Uh, so while many things can be done, and some people may do it, the best way to do it, or the ideal way to do it, is create a solution, but then you raise money specifying that this is what you're going to do. And then you have a mechanism in place which is fair for fund one or the fund from where the assets are going, and is fair for investors of the continuation.
So I'm imagining that the way your investments happen, it would be like a funnel where the top of the funnel would be you would be scouting or you would be receiving inbound applications, and then you would have some sort of filter process, and then there would be some sort of deal making negotiation happening. Tell me about that whole funnel.
So funnel is that in the first one we had more than 2,000 opportunities that came through our door.
And these are inbound.
These are inbound. So we largely have three ways in which we get deals. One is that we do a lot of proactive uh, exercises, right? Because we have looked at when evaluation of countries happen, what kind of categories get created. We talked about some of that earlier, right? So we have a view that these segments are going to do well. So in those segments, we don't mind doing proactive, uh, scouting exercises where either through ourselves or by appointing an advisor, we go out and say that let's scout for these kind of things. So that's one. Second, that we have a large number of LPs. And many of them are entrepreneurs in India. They run sophisticated businesses. They get a lot of deals, which they take away. And the good part is that somebody who is in the trade or somebody who is running that business or running that kind of business has some fundamental interest or at least a desire to evaluate the deal, and he's selling it to us. And third is that we have a large network of boutique investment advisors and chartered accountants who get us inbound deals. Many of these things have to scrum a little bit because they are not, fancy presentations made by, a budget bracket bank, but instead these are things where you have to, go through annual reports, you have to go through, you know, whatever Excel sheets of data that are shaped with. And but sometimes you could really find nuggets, if you're willing to do the time. So through all these three processes, let's say we during the course of fund one, when fund one phase, we looked at more than 2,000 deals. Um, Only 300 of them met our objective filters.
Like 30 crore plus top line.
30 crore plus top line. I mean, it was slightly different in fund one. I mean, fund two, you won't have filters, but yeah, uh, your revenue cutoffs, your sustainability cutoff, your stake cutoffs, and so on.
First generation entrepreneur and some others.
Jobs. And then out of this 300, let's say we would have engaged actively, where we would have done a management call, poured through the numbers in about 60% of these transactions, right? So let's say, you know, uh, if we got 300, then about 180 of those we sort of. And then after one meeting or one call, etc., that number would drop to, let's say, I would say 50. And we would have given term sheets out to 10 companies. Um, we did diligence on 9 and we invested in 8.
So my last question to you, we are like living in a new normal is what everyone says. How do you think you will change as in terms of your investment thesis, your operating philosophy over the coming years? Do you see that changing, or do you think that these fundamentals will stay as they are?
No, I don't think our fundamentals will change. See, we are looking at. I mean, if I look at when you say new normal, I think we are talking about in the investing world. We are talking about tech, and we are investing about businesses. Which so for us, tech is means to an end. People, processes, tech, capital are needed to build a business. It's not that our businesses are bereft of tech or devoid of tech. We business has all the best tech stacks that you can find. Biryani is the pioneer in chefless biryani, which is to me real food tech. You Tech for me is not necessarily just sending on sweet tomato. One of our industry spaces has built a SaaS product, for the ecosystem, which has got great potential. But to us, people, processes, tech, um, capital are means to an end. Whereas D2C is a channel of sale. We have to embrace it. But D2C is not a paradigm. It's not a destination. It's means to an end. So we have to imbibe. I mean, for example, if I could guide a company, or if a partner, Arvind, for example, he could guide a company in terms of how you should go about building your brand, and what you could do digitally was not part of that. That needs to be imbibed. You know, and you can't in a modern day of tennis play with a wooden racket. Uh, so you have to change with the times, but the philosophy doesn't change. We still think that if you want to do tech, you can go to Silicon Valley, you can go to Israel, tech is global. Everybody uses Instagram. The and people might do tech and they'll do well. From our perspective, we are looking at a very compelling opportunity, which is very core to India, which is a market that we understand as Indians. I was Indian on my sleeve. I went to IIT, I went to IIM, I'm an Indian, I stayed in India. The most compelling opportunity that India can give you today is the demography that you see, which want to spend, the spends which are going to happen, and the kind of brands and services which are going to create. In the process of these getting created, we'll embrace D2C as a channel. We'll embrace tech as a source of efficiency. And we want to embrace that. Our companies want to embrace that. But to us, we you can't embrace it at the cost of building a sustainable long-term business.